Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, December 27th, 2019. I wanted to cover just a few things, some of the things I'm watching and been covering lately. I want to we'll look at the markets real quick, do a brief update. I've posted quite a bit of analysis there, some updated charts, so check those out on the front page. We'll just touch on those quickly. I'd like to talk on Palladium. I added that as an official trade today. Crude oil, I had a request in the trading room for update on crude oil and the energy stocks and those ETFs that I've been highlighting recently, as well as gold and the US dollar. So let's just start there. That should be enough. Again, it's not an all-inclusive video. There's so many things out there, but those are some of the things, at least at this point in time, I'm watching. So let's start out with the broad market, because this kind of, in a way, directly or indirectly impacts almost everything else, such as gold, for example. If we've been trending up, gold's been moving recently, but you'd have that much more of a bid beneath it, or a tailwind to a gold trade, if the stock market was correcting, because then you'd have a flight to safety, a bid that could quite possibly get underneath gold and help drive it. So again, I don't want to beat a dead horse here. These are levels I'm watching. You have the trend line, the uptrend lines, SPY, QQQ. Again, the small caps broke down today, as I mentioned this morning, posted an update. Here's just a different variation. You can see the trend line here on QQQ. You can play around with it. Maybe we get another reaction there. Maybe it's right there. I also like to watch the futures as well. And you can see, you can see the algos are just having a field day with this market. Computerized trading, and there's individuals too. That don't get me wrong, it's not the only thing driving the market, but just look at this trend line. Look, it starts back here, December 10th. I had one back on some charts I have coming off December 3rd, but you can see a lot of clean reactions. And lately, just look how nice and clean those reactions, including the one this morning. So we fell there, and there was a big impulsive move down to get there. We hit that level to the penny. You can see how well these reactions are working. So whether it's humans or computers or a combination of both, undoubtedly it's the latter there, that are stepping in and buying. It's sooner or later these levels break, and the better defined that they are, the better the chances that you will get a pretty quick drop. So again, what I mean by that, if you have a marginal trend line that you can a couple reactions there, maybe they're not clean, or minor support levels. I'm just adding a level there that's probably going to come into play as I'm talking. I can see that I didn't have that level on NQ. So again, the better defined a level is, the better the chances are that once it breaks, you'll get some selling. Stops will be hit. Instead of buying pullbacks to that support level, some traders will flip into short mode and short sell. And again, you can see a little support there about 87.45. So that's that. We continue to move higher. Make no mistake about it. I try to be clear. I might bearish speak for days, weeks, months. And there's a big difference between an actionable trade or sell signal and bearish developments. That's the difference of a trade setup and an actionable trade. And so right now we need to see this break, and if so, then we'll probably see the large caps continue down. Let's talk on the small caps real quick. They broke down today impulsively, as I mentioned this morning in that update, and I said I would expect them to flag. And the reason I said that, because at the same time, this is a clear, unmistakable breakdown, pretty clean trend line, impulsive selling, everything you want to see, all the check marks across the board, except probably the most important things, and that is, even though small caps are not large caps, there's not a single stock in the Russell 2000 stocks, and there not a darn one of them is in the S&P 500 or NASDAQ 100 or Dow. Those are all large cap indexes. However, that's where most people trade. That's where most of the money in the stock market is, in the large cap arena. And it is certainly possible, and I've seen it happen before, for large caps and small caps to diverge. In fact, the small caps are still off highs that they put in, was it last year? Well off the highs right now, while the large caps going to make new highs. So, but with that being said, for the most part, they track together. If you put up, go back 20 years, overlay a chart of the Russell 2000 and the S&P 500, you're going to see the major trends, the major ups and downs are in sync, the bulls and bear markets. So I want to point that out. Now, with that being said, we broke down today, so you have a lot of check marks, but the only check mark you didn't have is the large caps. At the same time IWM fell to here, or RTY, these are the futures, same time they fell to here, and with that big impulsive candle, you had the major large cap, all of them, ES, of course, NQ, they hit support, their trend lines, and bounce from there. And so that I talk about this often. Even if you are only trading small caps, RTY, you're doing yourself a disservice if you're not closely following the charts of the large caps. If you saw that, especially when you saw them hold that support and start to reverse, you could have covered, had you taken a quick short on RTY, or maybe it would have given you pause on taking a short. There's your sell signal. Maybe normally you might say, okay, that's still objective because we're going here and then down to here. However, yeah, so that's why I put out that post this morning that, hey, yeah, small caps broke down, large caps are close, but no cigar yet. All right, so enough on that, and just look at that ES again, right on the trend line, and these can break down any day now, and that's why I put these charts out. That's what I said in the update I did today on QQQ and Apple. I put these out there. I have no doubt there's some people saying, Randy, you're crazy. Why are you even posting bearish setups and pullback targets on Apple? It's in a super strong uptrend. Everybody wants to buy it. It's going to go up. And it may. There's not any sell signals, nothing close to sell signals on Apple, as I covered in that post earlier today. Just showing you a couple different levels. But there's certainly the potential, and if the market breaks down, because Apple's a top component of the NASDAQ 100, it's also a top component in the S&P 500, it will come under forced selling if and when the indexes drop. So it's all kind of tied together, as I said, and there's levels to watch, as I gave you a little uptrend line on Apple. That breaks, that'd be your first sell signal. There's your first decent support. I highly suspect the buyers will step in and buy the first pull back to 279, just north of that, and then if and when that goes, which I suspect will come down here, and that would be a pretty decent drop in Apple. And if that happens, that's from where we're at now, about almost 8%. And if we overshoot it and hit this longer term trend line that was on that chart I posted today, you can see it coming off the early August lows, then yeah, you're talking as much as about a 10% correction from where we're at right now. And again, maybe soon, maybe not. Just remember that it's, when you get these one-sided market, that's usually where the quick moves come from. It's like a game of musical chairs, and you have these momentum traders and people that have been chasing the FOMO trade. And when the music stops, meaning the trend changes, sometimes you can get a quick rush for the exits. Everybody trying to sell at once, a lot of stop-loss orders getting hit at once, and that's what causes those quick downs. And that is why I love to short stocks, just like I love to go long stocks. But when you're shorting, you tend to make more money in quick order. You just have to be, your timing has to be good during an uptrend if you're shorting as a counter trend trade. We're in the next bear market, whenever that starts, then shorting will be the primary trade. And just like in a bull market where longs and bulls get bailed out even for making the worst mistakes, you're in a bull market, you can buy at absolutely all the wrong times, all these peaks here, but you get bailed out. And there's an old saying, never confuse genius on your part with a bull market. And so, at some point in time, will be in a bear market, and then you can, hold on to your shorts longer. But for now, they're just tactical trades. They're quick pullback trades, and maybe more. Well, again, I'm not going to get too deep into the charts now, but as I mentioned here on the daily chart, we're at that level I showed you that's not marked up here. You can see it on the front page, those double tap readings when you have the consecutive tags of this extreme level, about 80 on the RSI. This goes back a couple years. You can see every other, there's not a lot of incidents here or samples to use. And you're, if you're a statistician, that you want a lot of data points, and this isn't many, but yeah, again, I could probably go back for years and see similar things here. And more importantly, it's been the trend du jour, at least over the last couple years here. So it's something to note. And as I've been saying, the risk reward is not attractive. That doesn't mean that your market must drop. It's just saying chasing it here with these overbought conditions, divergences, similar technicals that have led to these big drops in the past. The old saying is, history doesn't always rhyme, but it often, or history doesn't always repeat, but it often rhymes. So that's that. Let's move on. Let's get away from the broad markets. Just watch those levels. And I know I didn't give you SPY, but SPY, same thing here. There it is. SPY, like I mentioned, SPY and NQ, or IWM, I should say, cracked the other day, but it's tech stocks. The S&P 500, although it's more more representative of the overall stock market because you have 11 sectors, whereas in NASDAQ 100, QQQ, you're concentrated. About half the holdings are in technology. And you know tech is the largest sector in the S&P 500. You also have other diversification. You have financials, for example. The NASDAQ 100 does not have any financial stocks in it. Doesn't have no banks, or I think it doesn't have any financials at all, unless anything's changed in recent years. So it's really, like I always say, it's a tech fund. I like to joke around calling it a XLK, or a tech fund with an Amazon kicker, because Amazon's such a top weighted component, and that's not technically a tech stock. Okay, and let's talk Palladium. The big levels. Personally, I like to watch the future. I like to watch both. This one trades well to the technicals, PALL. I had a question from a member in the trading room today. She asked, Randy, how can I short? She prefers options, and because you can limit your downside, your loss if wrong. And unfortunately, PALL, it's the only ETF that I know of, and I'm almost certain, I've done a search, I believe it's the only one out there that directly tracks Palladium. You have there's one out there, I think it holds platinum and palladium, but if you want a pure play, it's either this or Palladium futures. And on this one, unlike a lot of ETFs out there, this one does not have any options on it. So if you want to profit from a drop in Palladium prices, my answer was, you can either short PALL, and if you're not comfortable shorting, as that member wasn't, and you can't do options, and you don't want to do the futures. Remember, the future, if you're not comfortable shorting this, you do not want to short PALL. Depends on your bankroll, how much money you have, but this is a big contract. Like I said, this contract is $187,000 per. Represents almost $190,000 of Palladium. So do the math on a 1% drop. That's what you're going to gain or lose. Every time this thing moves a percent, you'll make or lose 1% of 187,000 and change. So PA you can take any, or PALL you can use shares. And what I was getting at here is, so my response there, if you want to profit from a drop in Palladium, and you're not going to use a short on PALL, there are some miners that you can short as a proxy, and I started working on a watch list today. I have it here on another monitor. There's a few companies here, like for example, SBGL. The name is deceptive. It's Sibane Gold, and however, when you do the little due diligence, look at the fundamentals on this company, and I saw their CEO a couple months back on TV. Gold is less than 20% of their business, and I believe that I took that from what the CEO was saying. Their business is skewed towards automotive, which is platinum, palladium, and rhodium. So therefore, this is an indirect play on palladium prices. Should palladium correct, or when the next bear market starts, chances are this company is going to drop, even though the name gold is in it. Gold is less than 20% of their production, so more of a close to being not a direct play, but again an indirect play on platinum and palladium. Okay, and just so back to that trade, so far the high of the day was about 1882 and change versus my, that former support about 1885. So we've now bounced back to resistance, which, back here when the 1800 level held, we had a brief momentum fueled overshoot. I went over it at the time. All 60-minute candles closed on or above 1800, and we've bounced from there. This was an impulsive leg down. Support, once broken, becomes resistance. So let me just say this plain and simple here. I can't guarantee this or any trade will work out. Now, that's the only guarantee I'll give you in trading. You never know which one's going to pan out. All I can say is it's objective to short a bounce back to resistance with a stop somewhat above. Stop is set up here somewhere because you want to give it a little room. The algos are, especially on things that are easier to manipulate. In other words, it's easier if I run a some type of hedge fund or a an algo program, and I've got hundreds of millions or even billions of dollars of capital to work with. It's a lot easier to move something like Palladium futures than it is to move, let's say, Apple. It's going to be very hard with a market cap of over $1 trillion for any one buyer to try to move the stock to their thing. So what I'm getting at here is the market maker, powers that be, could pop that level, try to run the stops, but It could also be that this was just another blip on the way up. This thing is in a bull market, a larger uptrend. So I guess what I'm trying to say is don't get married to it. You're going to have to use a stop at most, I would say up here about 1925, 80, a little bit above that level. That's resistance that if that's taken out, this one's probably going to go to new highs. In fact, I really prefer to see it come down here. And you can see that it's a couple things that I've noted today, and this is why I had the, I went ahead and added as an active trade. We broke the uptrend line, this little wedge right here, broke and back tested right around that 1885. I like that. Shorting at resistance, that's TA 101. It's objective, doesn't guarantee it'll pan out, and you can keep a tight stop too if you want. Like I said, the tighter the stop, the greater the chance if they want to pop the stops and then turn around before it drops, that they're going to get you. So it's up to you on where you short, whether you even take it or not. It's a counter trend trade, guys. Please know that if you haven't figured out by now. I'm a fairly aggressive trader at times. I like taking counter trend trades. I like at times catching falling knives. Sometimes you get your fingers cut, but the thing is, you have to use stops if you do it, and just don't let the trade get away from you. You're going to win some and you're going to lose some, and over time, if you're using an attractive risk-reward ratio, meaning you're risking $1 for every $2-3 or more of profit, then you can actually have less than a 50-50 win ratio and still profit in trading. So it's all about not letting your losers run. You want to let your winners run and cut your losers. So that's enough on that, and let's just go back to PALL and go back to there. So you can see both of them are at resistance. That's that comparable level right there. There's the stop for the trade, there's the targets, and that's it. Let's just see what happens. PPO's just coming up to back test the zero line from below. That often acts as resistance when it's a trend indicator. When the PPO signal line, that white line here, the 9 EMA, it's a dotted white line. When that's above the zero line, which is this dash line here, the trend is bullish. And not only that, but the that zero line often acts as support on back tests. All these are back tests. See the white line, and I use that because it's the last of the two to cross, so it tends to help filter out whipsaw signals, and you can see just how well it's done. And there, boom, that was a sell signal we crossed below right about here, and it also was a sell signal on trend line. So this is a great example of a technical analysis. You had to sell signal with the trend line break. It was then confirmed with the bearish crossover, that PPO signal line, the 9 EMA, and then you had a back test. This was another objective entry on the back test, and the signal line made a back test of the zero line from below, and there was your correction. At this point, the zero line was regained, so this trend indicator flipped from bearish to bullish, and that was, so far so good. This was the first time we've had a bearish cross of the zero line since, and we're still there right now with the signal line back testing as I speak. And then, it can be a hair over or hair below. Don't have to, sometimes I get those questions. Hey, I see it crossed, it's a rough level. Just like with trend lines, sometimes you'll slightly overshoot or undercut a level. And that's it. Really shouldn't spend much more on that because this trade's either going to work or it's not. All right, let's move on to the next one. Let's go to something related, which is gold, GLD. Gold did an update just yesterday. I've updated this quite a bit. We're right at, remember I had that resistance on my daily chart at 142.85, and I said yesterday, the risk reward's just not attractive right now for the near term. We hit a high today of 142.73, close enough. Again, these lines, are not zeroed in to the exact penny. They're just roughly where those resistance levels are. So that's, effectively a tag of that level. As you can see here on the RSI down below, gold is overbought on the daily time frame. Now, in a bull market, it's not unusual for overbought to become more overbought or stay overbought for an extended period of time. That is a signature, in fact, of a bull market. That's what helps tell me when I look at a chart, a long-term chart. That helps tell me whether you're in a bull or bear market, because in bear markets, it's probably not the best one to use. We'll look at a weekly chart here. In a bull market, you can see the RSI stays up and it stays overbought for quite a while, and you hardly see any oversold readings. And if you get an oversold reading, that 30 level during a bull market, that's usually a great buying op. It's usually one and done. You can look at the stock market, you'll see the same thing. However, when you're in a bear market, everything's in reverse. Oversold tends to become more oversold. You have more frequent tags of the oversold level, and rarely are you going to see overbought. And the bear market started right here. We didn't really know that, or couldn't say with a high degree of confidence until after, after really about this point. But with that being said, in hindsight, we can look back and see we had a near push to the oversold reading, and it was a great, one of the best and last great shorting ops in the last bear market in gold. But remember, we bottomed right here. This was the end of the bear market, beginning of the bull market. So what do you see there? Persistent overbought readings. That was one clue that a new bull market was underway. Another clue was we came back, hit this 30 level to the button and reversed. Like I said, in a bull market, it's usually one and done. When you get them, jump on them. Oversold readings, that is. And then again, overbought, and more overbought. So that's the bigger picture for gold. Where am I going with this? Near term, look, we could get a pullback. As I said, I don't have any desire to short it. And we may not get a pullback because overbought can continue to become more overbought. In fact, we just broke out in gold, and sometimes after a breakout, everyone sees that breakout. More and more people see it, the more it can run. So there's that. And like I said, if you have that FOMO, fear of missing out in gold, you can scale in. I just wouldn't take a full position here, and I think that's everything I said the other day. You can add some now. If it pulls back, strategically, you don't want to see it drop back below this triangle. That wouldn't be a good thing, and most importantly, below 136.58. That's quite a ways down if it gets there, but the more it rises from here, the more bullish it is for gold. Meaning you're just burning through, overbought readings and things like that. Also note the PPO crossing over here above the zero line. All right, on a related note, somebody asked about the move in the dollar today. If you followed me for a while, I've been talking about what I think is quite possibly a major top in process in the dollar. And that means a bottom in the euro. The euro is the largest component of the dollar index. I believe it's a 57.6% weighting. It's by far the largest weighting in the dollar index. A distant second is the yen. Everything else doesn't hardly even move the needle. So when I use this as a proxy for the US dollar, is looking at the euro US dollar forex pair, and we're at that 118.19 target now. Remember, it's more of a target that's already been hit, but it's a key resistance level. Big move up today, or pretty good move, impulsive move right to that resistance level. So really what I'm seeing here, it's we've been tapping. We broke out of the downtrend line right here. That was bullish, ran up, hit that 118-ish target, pulled back tested the trend line, and so far we've reversed. Successful back test. So basically a solid break above that level should open the door for my next target here. And the more this happens, the more we play out like this, start moving away above this level, the more it will become clear to everybody from a technical perspective that the dollar has broken out, and or the euro has broken out against the dollar. So that's basically the dollar in reverse. This is the dollar ETF if you want, or ETN if you want to trade it. Same story in reverse. There was a big rising wedge, bearish rising wedge pattern, divergent high, negative divergence here at the high, breakdown, little kickback rally, and boom, their dollar's falling, coming up on my first or next target now, about 25.89. All this, why I rolled into this after gold. Remember, gold tends to have a inverse correlation to the dollar. That is I've covered those charts many times in the past. You can do it yourself. Overlay the US dollar with any chart of gold. Go back 20 years as long as you want. There are temporary disconnects between that inverse relationship, meaning one goes up, the other goes down, but it holds, and it's a very simple reason. It's math, really. When the dollar falls in value, it takes more dollars to buy an ounce of gold, and if the dollar goes up in value, it takes fewer dollars to buy an ounce of gold. So therefore a falling dollar is bullish for gold, and so this helps to confirm my longer term bull market outlook that gold just broke out and may be poised for the next leg up soon. And the only thing that could really look better right now for gold would be a breakdown in the stock market and get that flight to safety bid. We may or may not get that before the end of the year. We may get it in January. It could come in February. Who knows? We'll just watch those levels I covered before. And, when we break down, get some solid sell signals, I will most certainly highlight that if and when it happens, or when it happens, I should say. All right, crude oil. Somebody asked about crude and the energy stocks. Crude continues to rally. Oh, on this chart, I wanted to show you CL. I should have posted that this morning in the charts I'm watching. This almost mirrors the stock market. This is CL, crude futures. And as I've told you many times, that the crude, especially recently, has been trading nearly in lockstep with the equity markets, has for quite some time now. It doesn't always do that. There are sometimes some supply-demand, specifics to crude, but for quite a while it's been trading highly correlated with the stock market, which is really with economic growth expectations. Stronger economic growth, more demand for crude prices go up, and you can say whatever reason you want, but I can tell you this: the technicals are lined up. As I just showed you, ES and NQ bouncing off trendline support on the 60-minute chart. Here's CL bouncing off 60-minute support. Yeah, you have a little divergence there. You had a small divergent. You had a divergent high here with a trend line. That was a trend line at the time. You had impulsive break, and we hit that first target right there, first support about $60. This was the breakout point I highlighted a few weeks back when we were here. We broke out, danced on that 59.69 level, and started moving away. So pretty much where I'm going with this is I would expect that if and when NQ and ES break down, SPY and QQQ, that crude will follow either at the same time or shortly afterwards. So and I can also say this: trading crude over the stock market, you get more bang for your buck because it's a little more volatile. Meaning, if the stock market drops 3%, crude will probably drop 5, 6, or more. So there's consideration. That cuts both ways too, that extra volatility. So just keep that in mind with your position size. But there it is, and these are the targets, and maximum target at this point in time would be this longer term, this uptrend line right here that comes off, it was about late September lows. So there's crude, and make no mistake about it, that will directly impact the energy stocks. Right here, there's XLE looking good after the breakout here, but getting a little tired right now. And again, crude is poised. Any little downside, another % or 2 from here, crude breaks down, and then the energy stocks will probably break these comparable trend lines. You can see it on XLE, XOP, and XES. So not a bad time to tighten up stops if you've been in these trades. I've highlighted these as the energy sector as my favorite of all the S&P 500 sectors by far, without even a close second. And it's certainly outperformed in the last few weeks. And but now, like I said, getting a little ahead of itself. You can see XOP starting to crack here with a red candle down below that level. There it is. I'll tighten that trend line up. You see it a little better on the 60-minute chart. Let's put it on there and see where we're at. We can do this. We could drag it out here, give it the benefit of the doubt, but any way you slice or dice it, I have XOP starting to crack. Now, it's only going to go down so far if crude continues to rally. Keep that in mind. But if you're in XOP or Gush, which is a 3-time leveraged version of this, tracks the same index, good time to either tighten up stops or take profits. And if you're a quick, nimble trader, drip, you can go long drip, which is the inverse. It's the opposite of Gush, 3-time short on the exploration and production stocks, and you could probably get a quick pullback trade. And remember, you have to take that 3-time leverage into account with your position size, but I'll have to play around with the charts. I didn't really intend to get price targets. I just wanted to say that crude and the markets will probably break down together, and if so, these guys are going to pull back. And the other one is XES. You can see XES already hit that resistance zone, target zone here, about 815 to 832, and it's rolling over. Not a hard roll yet, again, because crude's holding up, but just poised to drop if crude breaks that 60-minute uptrend line that I just showed you. So there's a chart. There's a trend line somewhere along these lines on XES. And by the way, this is still a longer-term bullish chart, this breakout and everything else. So personally, I'll be looking to recycle back in on a pullback if and when it comes. And if you want to know an objective level, I think I don't know if we'll get there, but depending on how the charts look at the time, I think anything back down to that 750 area on XES would be an ideal spot to add some long or buy back into longs that were closed out or stopped out here. Yeah, that's pretty much it. Let's keep this video under 30 minutes. Bitcoin still has a potential to run, and again, just because this tends to be a risk-off asset, it would help to see the stock market break down. There's a minor trend line, but we're dancing on. We pulled back. We hit that first target ahead at 77.54, pulled back, and we're back down to that 71.64, holding above that support level. So pretty much, ideally, Bitcoin needs to hold above here. There was a brief little stop clearing move. So at this point, we have no business taking out that reaction low, that recent reaction low there, or we'll probably drop. That would be my guess. So good time to tighten up stops. And if you haven't gone long, it's objective right here. It's anywhere above 71.64, or maybe a break out of that trend line. We already had a reaction at 77.54 once, although we may get another one. I'd favor a move up if we get there again to go on through it and hit that next target there at about 8,000 or so, and maybe these potential targets here. So a little more work to be done. Still bullish on it, but not crazy about the post breakout action. Remember, we broke out here, back tested, had that run up, hit my first target, pulled back. I want to see it now charge back up and go on and make another leg up. Then that will help firm up the case, for more upside. But again, it's objective here. Not my favorite trade, but certainly it's asset allocation. I like to spread my bets, and don't put all my eggs in one basket. And that's the key. You have a little Bitcoin, you have a little gold, you have a little bit of energy stocks, whatever else you're trading, and one day one's going down and two or three others are going up, and it helps smooth out the bumps. All right, guys, let's wrap it up here. Let me get this video out to you, and if I see anything else that stands out, I'll make sure to post a front page update. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.